record to the cloud, and I'm going to stop sharing, and I am turning it over to you. Please take it away for our participants.
Okay, thank you, Steve. Let me, let's see, need to get to share my screen. Where is that tab? I'm not seeing the share tab. Oh, there it is. Okay. Okay, we good to go?
Good to go. I can see you fine, and I can hear you fine. I mean,
Okay,
I can
great.
see your presentation fine.
Thank you, Steve. And excuse me, thanks to all of you for being here. I appreciate it. I published my first book in 2011, and you can still find it on Amazon. It was published by John Wiley. And I termed it No Hype Option Trading. Now, the reason for that title was simply it reflected the journey that I had made since 1999 when I made my first options trade, and the false starts, the nonsense, marketing hype, etc., that I ran into. So that's part of what generated today's talk, is that history. Now, on this slide, I've listed actual statements that were either made in webinars or in presentations at trading conferences, or on emails marketing a course, or on websites. First one you've probably seen before, you should only place low risk reward trades. For example, only risk $1 to make $3. Next one, if I place a condor trade with an 84% probability of success, I will make a profit 10 months out of the year, only have 2 losing months, and therefore be profitable for the year. Next one came in an email advertising a course. We will teach you how to find low risk, high probability trades. It sounds wonderful, doesn't it? Next one is how to risk $156 to potentially make $1,000. Wow. Next one, we will teach you the secret strategies used by the market makers and floor traders. Sell credit spreads when IV rank is high and buy debit spreads when IV rank is low. And the last one, there's no need to adjust, just let the probabilities work in your favor. So that brings us to the first of this discussion, probabilities. What you're seeing here on the slide is a Gaussian distribution, otherwise known as a normal distribution, or just simply the bell-shaped curve. Now, this particular plot is from a real set of data of a group of men that were entering some kind of diet program. And this was the distribution of their weights from a little over 100 pounds to almost 300 pounds, and the average rate was around 200 pounds. Now, how this curve works is at any place on this curve, let's say you chose this number, let's say this is 190 pounds. Then really what this is corresponding to is how many people in that group are at 190 pounds. And so if you had that probability number, let's say it's 35% or something like that, it would be for the number of people that were at that weight or below. So if you walked into that ballroom where they were all meeting and you were blindfolded, and the first one that you randomly touched, you'd have like a 35% probability of that person weighing less than 190 pounds. So that's how a probability distribution works. Now, this is the Black-Scholes model, which is the theoretical pricing model for options. This was published back in 1973. This first complicated monster is the theoretical call option price. But the thing to pay attention to is look down here at the very bottom, this Greek symbol, phi, which is like a 0 with a vertical line through it, is the normal probability distribution function. That's that probability function I was talking about before. Notice how phi is in every one of these terms. Doesn't matter whether you're pricing the put, pricing the call, phi is in every term. Now, what that tells you, without even thinking about this equation any further or getting worried about the complexity, is that the price of the options, the price is based on the probability of that option having value. There's a lot of other factors, of course, but that's a primary factor that's always there. It's part of the foundation. So, for example, what if we said we were going to sell an iron condor on an index and position our two spreads? We've got a call spread up above the index, put spread down below. We'll position those two standard deviations out of the money. Now we'll do that on the first of every month. So on January 2nd, we would sell that condor with the January options and just let it run to expiration. Now, two standard deviations on both sides gives us a probability of about 84% of both those spreads expiring worthless, and we achieve our maximum profit. Now, at first glance, that seems like a pretty good deal, doesn't it? The problem is, if you did that every month for the rest of this year, you would be surprised to see that you didn't have any gains. Now, we'll talk further about that. That high probability trade that I mentioned, say 85, 90, 95% probability of success, is very attractive. Let's use an example. On Monday, SPX closed at 38.55. You could go out to February and sell the 34.90, 3,500 put. Now think about that. You're over almost 400 points below the current price. You could sold it for 55 bucks. So that means your maximum profit is if that expires worthless, you collect $95 or $55, but your maximum loss is $945, quite a bit. But you don't pay attention to that because you're focused on 95% probability of success. And so you're gaining about 6% in 25 days. Now, at first glance, that looks pretty good. You know that there's a probability of a large loss, but it's a small probability. I think we can ignore that. Well, let's think about that. If we look at the long term, let's imagine that I put this trade on every month. Do it for a year or two. The long-term probability should be 95% times the maximum gain and subtract 5% times the maximum loss. And we come out with an expected return or a long-term risk-adjusted return of $5. That's not very much. Now, that doesn't count in trading commissions, slippage. So in other words, what we're finding here is the expected return for this trade, even though it had a 95% probability, is going to be roughly zero or even possibly negative. That loss only had a 5% probability of occurring, but when it did, it wiped out all those small gains. Now, when we look at that, we think, well, we must be on the wrong end of this. How about a low probability curve? Well, let's look at that. On Monday, you could have placed this trade on Apple. It closed at $143, and you could have bought the February 160, 170 call spread. You'd have spent $113 for that. Maximum profit is $887. Maximum loss is just that $113. Now, this often, you'll never see this trade advertised as a low probability trade, but that's what it is. This trade will always be advertised as the low risk trade. In other words, they'll focus on this number. You can only lose $100, but look at what you can gain. Whoa. Well, they don't tell you the probability of that happening is only 9%. So let's look at the long-term risk-adjusted return again. 9% times 887 less 91% times the maximum loss. Now it's negative. Before we even put all our trading commissions in, it's negative. We can set up this kind of trade month after month or week after week, however we're doing it, and always use the same parameters in terms of how far out of the money we are, etc. And what this is telling you is that over the long term, you're not going to make a profit. When you finally get one of those big winners, you get several 100% win, you've already lost so much money with all those tiny losses month after month. It's kind of like playing the lottery month after month or week after week. Well, in that case, the probabilities are so far against you, you may play it for years and never win. So the point here is that the pricing of options is fundamentally derived from the probabilities of those options expiring with value. So you have two extreme probability trades or strategies. You have the high probability trades that we just talked about. You get a relatively small return, but there's a low probability of a pretty large loss. Low probability trade is just the opposite. You have a low probability of a big win and a high probability that you're going to take a loss most of the time, but it's going to be pretty small. The thing to realize is that neither one of these trades gives you an edge. Think about this game as kind of like being in a casino in Las Vegas. If you own the casino, you're sitting there looking at the tables, walking through your casino, and you find me sitting there with a big pile of chips in front of me. And you realize I'm having a good afternoon or evening or whatever it is. Are you worried about that? No, you're not worried about that. You want to be sure nobody's cheating, but you know the probabilities are on your side, that you have an edge in this game. Well, that's what we're talking about here. How do we trade options so that we aren't just doomed to failure? We need an edge. So what I have in red here in the middle of this slide is the bottom line. The long-term risk-adjusted returns of all option strategies will tend toward the cost of capital, less commissions and slippage. In other words, roughly zero. So before you despair and give up and sign off and never want to talk to us again, let's go back to that SPX put spread I talked about just a few minutes ago. We saw the long-term risk-adjusted return was roughly zero. Now, what about if we change this term? Remember, this is the maximum loss. What if you just put a simple stop loss in? And I've just said, well, what if we just limit that loss to half of the maximum? Well, suddenly your return starts to get a little more reasonable. 3% a month, if you could do 3% a month all year, that's not bad. So you see, the point of this is that if you just go by the probabilities, you're not going to make money in this game. The only way you put the odds on your side, the only way you get an edge, similar to how the casino house does it, is you've got to have some risk management techniques of some kind. Could be very simple, could be very complex, but in any case, what they do is they prevent you from ever taking that maximum loss. Then the long-term risk-adjusted return starts to lean toward your favor. By the way, I didn't say, but that long-term risk-adjusted return is also called an expected return. You'll see that terminology, the expected return. So we can start to shift that in our favor simply by applying risk management. That's why risk management is really the secret of trading. I don't care what kind of trading you're doing. You could be trading currencies, commodities, options, stocks, whatever. Risk management is the secret. People are often talk about the secret. They're searching for the secret. Well, in trading, the secret is risk management. So let's look back at our list of trading myths. The very first one, you should only place low risk reward trades. Only risk $1 to make $3. Well, we know now that that's a classic low probability trade. You can say that all day long and even say, oh, only risk $1 and make $5. Whatever you want to set up there. The bottom line is that that doesn't go anywhere. That dog doesn't hunt, as they used to say. What about the next one? We'll teach you how to find low risk, high probability trades. There's no such animal. What they advertise as low risk trades are low probability trades. What are advertised as high probability trades have a low probability of a big loss out there somewhere, potentially. Maybe a small probability of it happening, but it's there. So there's no such thing as a low risk, high probability trade. The classic high probability trade, as we saw just a moment ago, just had a large loss that was lurking out there in the bushes. Next one, how to risk $156 to potentially make $1,000. Obviously, another low probability trade. Remember, ours was like $113 to make $800 or $900. It's a low probability trade. Now, there's two more that they have here that I'd listed. This first one about the condor. If I place that condor so that I've got an 84% probability of success. Now, I chose that number because that's 2 standard deviations. In other words, I'm taking a big chunk of that curve and saying everything in here I'll make money off of, and just leaving these little sleeves off to the side. But we know that the losses out on those edges will wipe out our gains, because we know the expected return tends towards 0 over time. In this last statement that I heard somebody that you'd recognize the name in a webinar, he said, there's no need to adjust. Just let the probabilities work in your favor. As we've seen, it doesn't work. In fact, if you could do the experiment, you could go down to the marketing or to Chicago Board Options Exchange, go down on the floor and talk to people that are trading on the floor, market makers, floor traders, and just propose that trade. Just say, I've got this brilliant idea. I'm just going to buy a call and a put called a straddle on the S&P 500, the first of every month, and just let it run out. End of the year, what do you think? I'm going to be doing well, won't I? Typical person down there is going to look at you and say, no, you don't know what you're talking about. You won't have made anything, because they know how the probabilities work. Now, some of these myths come out of a misunderstanding of volatility. Now, I'm being polite when I say misunderstanding, because some of these myths are misunderstandings. Some of them are just marketing hype. They know better, but they're trying to sell you something. But think about implied volatility. Now, we could have a whole class on implied volatility, but the shorthand is this. Options are priced basically through an auction process. Everybody's coming in and buying, selling options, and sometimes they're willing to pay any price. Other times they pay a price up to a point and then they stop, so forth. So that price of that option is really a consensus prediction of the range of future prices of that underlying stock or index based on all those bets that are placed in effect. I mean, think about how it would work. Let's say you're predicting that Apple is going to hit $150 a share. And right now it's at 145. Well, now if the call option was $6, that's what you'd have to pay for it. You would know that it'd have to get over 150 before you'd be making money. So that would put a limit on where you were willing, how much you were willing to pay for that option based on what you're expecting the price to be. That's the market consensus. Now you might think, well, what do they know? Well, I agree. What do they know? The interesting thing is a lot of academics have looked at that question and found that the majority of the time they know. For example, they've looked at the price of a stock after the earnings announcement, whether it's much higher or lower or same, compared that to what the straddle before the announcement was priced at. In other words, the straddle is where you buy the call and buy the put. So you have an upper profitability limit and a lower profitability limit. As long as the price is outside of that, you make money. They compare that and they find that about 85% of the time, the options are priced correctly. The price ends up within that envelope. So the consensus actually does know what they're doing. Now, that doesn't mean that they don't get surprised. You know, Netflix, when was it, last week? I think they had their earnings announcement. Was a huge blowout. Now, that was like a 3-4 standard deviation move. But believe me, you can't place your profitability of your trading business on those kind of moves. But the bottom line here that I want to get across is that implied volatility comes about because the traders believe that whatever's going to happen in the future involves higher prices or higher price moves, either higher or lower, than what's happened in the past typically. In the past, it's only moved 10% or so. In the future, we're thinking it's going to go 50%. But it doesn't give you a direction. It's higher or lower. So therefore, when I have an option that has much higher implied volatility, it's much more expensive, but it also has a lot more risk. There's a big move that's priced into that. And if that move doesn't happen, obviously, depending on which side of it, you're in trouble. And you could be on either side of it. You could be predicting that it's not going to move, or you could be predicting that it is going to move. So think about this example where this is a common one where we're trying to sell options, either selling calls against our stock or selling puts, and we just have the cash. So it's a fully cash secured short put, but we're just trying to generate income. So we're selling options. Now, several years ago, there was a magazine called, let's see what it is, Stocks, Futures and Options. It was SFO magazine. And I had a column that was called Ask Dr. Duke. And so readers had sent in these questions. And I remember one time a guy writes in and says, I'm selling puts and I need to know, how would I go find the most expensive puts so I can bring in as much cash as possible? And I gave him an answer of how he could do that, but I also cautioned him and said, do you realize you're going to be selling the riskiest puts out there? I don't know if he did or not, because unfortunately I didn't get an answer. I just wrote the answer in the magazine that came out the next month. But the point is, sometimes we get a little carried away with those expensive options. Think about this one just currently. I think I priced this yesterday or Monday. You could sell that Tesla February option at the money, bring in $7,300, 9%. Now, 9% doesn't seem like that much, but after all, you've got $88,000 on the table. But in any case, the Apple option, roughly at the money or a little bit out of the money, you're selling that one, you're making 3%. And that's more typical of a covered call or naked put for an average stock in an average month. But when we look at those, do you automatically look at this one and say, oh my goodness, I want to get 9%. I don't want to get 3%. Well, yeah, you could make that choice. But do you realize the implications? That's the key. Lots of traders, unfortunately, don't realize the implications of that. There is more risk there. Now, if you sell these puts, if you sell Tesla and any number of other high volatility puts, and that's your steady business for a long period of time, your average return, your average profitability will be higher, assuming you're applying good risk management, than the person that's selling the conservative low volatility options. Their average return will be smaller than yours, but the one big difference that we're forgetting about here is when you're selling these kind of puts, like this Tesla put, you can have big losses or big gains. Your range of returns is much larger. You end up with an average return that's larger, but you've got a big range of returns. And you need to ask yourself, am I comfortable with that? This range of returns will be much more narrow. But both of them, in order to be profitable in the long term, have to involve risk management. Now, a related myth that I had on the slide was that when IV is high, you should sell credit spreads. When implied volatility is high, you sell credit spreads. When implied volatility is low, you buy debit spreads. Okay, Apple is having their earnings announcement while we're speaking. Now, as you probably know, implied volatility levels peak right before that earnings announcement, especially on stocks like Tesla. Tesla's announcing tonight too. Apple's options were running an implied volatility today of about 118%. 118%. That's a pricey option. Now you could have sold the January 129, in other words, expiring this Friday, the 135, 140 put spread, could have sold that for 185 bucks. The maximum profit there, assuming that Apple stays above 140, be 73%. That's selling the credit spread. Now, what if you bought the same strikes with calls, so you have the debit spread? You're buying the debit spread at 135, 140. It costs you 288. The maximum profit is the same. Now, I would encourage you to go out and do your own examples. Just price some stocks. When you've got a stock that you follow and you know that this implied volatility level where it is right now is very low historically, price out a couple of spreads at same strikes. Debit spread versus credit spread. You're going to see exactly what I'm showing you right here. The credit spread should have the advantage, should somehow return more, but it doesn't. Because see, the problem here is I'm selling a very high volatility put, but I'm also buying a very high volatility put. I'm selling an expensive put and I'm buying an expensive put. Therefore, the spread cancels out that volatility. Now, if you said, just like on previous slide, if you said, well, I want to sell that 140 put and I want to sell it now because volatility is so high, okay, fine, you can do that, but you need to understand the risk that's involved there. So in other words, this idea that sell credit spreads when IV rank is high and buy debit spreads when the IV rank is low, it's either marketing nonsense or the person misunderstands the effects of volatility. One more. I first saw this, in fact, the quote that I had on the slide came from an advertisement for a book that's probably at least 10 years ago. But it was a book about the broken wing butterfly spread. And the book was advertised as being the secret strategy that was used by all the market makers on the floor. And they were taking this great risk by exposing the secret in this book. Well, let's think about how market makers run their business. First of all, he buys some options and he sells others. Well, in simple terms, he's trying to buy at the bid and sell at the ask. He's not unlike a car dealer. Goes to the auction, buys a car for $5,000, brings it back to his lot and sells it for $6,000. Okay, well, that's the same thing that the market maker is doing. He's buying and selling options. Now, the difference between that bid and ask price is pretty small. He's only making maybe $1, $5, something like that, in terms of the profit, if he indeed buys it to one and sells it to the other. And that's why he has to take a bunch of trades. He's got to be busy. He can't be messing around. He's got to be taking every trade he can find. Now, how does he manage his risk? He keeps a constant computer program tracking his delta for his entire holdings. Now, he may have thousands of options in his portfolio at any given point in time. But that computer keeps track of all the deltas, sums them all up, and then he knows that he's either positive delta, a lot of dollars, say he's up $100,000, which means if that stock drops by $1, he's going to be down $100,000. So he tracks that and he makes sure that if he's up very positive delta, then he shorts the stock to get himself neutral, and vice versa if he's the other way. Now, the advantage he has over you and me is he can short that stock or buy it very cheap. He gets a real deal. Because after all, it's in the exchange's interest to make a market. And these guys have a service there. But the reason I explain this is to tell you that he isn't trading against you. A lot of traders seem to think that he's somehow the enemy. No, the last thing he wants to know is whether Apple or Google or whatever he's trading options in, he doesn't care where it's going tomorrow. He doesn't care whether it's going up or down. He's not making that prediction because that's not how he makes his money. He makes his money by always being neutral, so it doesn't matter whether it goes up or down, and he makes his money on the spread. Now, another thing, I've seen former market makers advertise their services and tell you that, just like that book, that the broken wing butterfly, that was one that was our moneymaker. Well, now let's be real. Think about that business. He's not buying butterflies or selling butterflies. He's taking whatever trades come to the floor. Now, when you looked at his whole portfolio of all these hundreds of options, yeah, you could pick and choose and say, oh, there's a butterfly or there's a whatever. Any trade you can think of, he's got the parts. But that's not how he's managing his risk. So saying that he somehow trades butterflies is just nonsense. Now, the other part of that, I call this particular fallacy the Holy Grail fallacy. And it's easy to see this. If you think about it, an awful lot of people in the trading business are wandering from one service to another, one guru to another, looking for the person that has the secret strategy. I know it's out there. And of course, listen to some of the advertisements. You've heard them. I've seen them on CNBC, Fox Business, other various channels, Bloomberg. People advertising their books and telling you how they made, turned $5,000 into $500,000 and that sort of thing. When you hear those advertisements, do the math. You'll be shocked when you do the math, what they're saying they did. They may say that they made 900% 2 years in a row. Well, that's not easy to do. Even if you made 900% someday, somehow, could you do it for a year and then do it again the next year? The best trading group return in my trading group this past year was 1,600%. But that was way out there. I think the next best was probably, I don't know if it was even 100%. It was somewhere like that. But the point is, making 900% for your entire portfolio 2 years in a row. And those are the kinds of things that you hear people saying. And it preys on people that think that there's some secret out there, that the Holy Grail exists. So my point here is to encourage you to think about the probabilities of options trading and the fact that no matter whether you prefer low probability trades or prefer high probability trades, that's not the important question. The important question is, do you know how you're going to manage the risk? You have to know how to manage this trade. You can't just put these trades on and walk away and go take a nap, because I can tell you where that will end up eventually. You may have a good month this month, but eventually, as they say, the chickens come home to roost. I've never owned chickens, so I don't know how that works, but that's what they say. So hopefully I have tempted you to maybe learn more. Parkwood Capital offers both private and group coaching. We have a course starting next Monday, 8 o'clock Monday nights, 7 weeks. It's on conservative income generation. So this is a variety of income generating trades, everything from covered calls, selling puts, selling what we call collars, a variety of different ways to trade and a lot of the nuances in that trading. Now, one of the benefits of that course is I actually mirror one of my own personal accounts and send those trades out to my students during those 7 weeks, just to illustrate. And then during the classes, I actually talk about, why did I put on that trade? Why did I close it this way? Why did I do whatever? And I use that as part of the course. In the last course that we did this in August, during the 7 weeks, if you put one contract in each trade, you'd have made about $12,000 in terms of the income. It worked out to about 7%, I think. Point is, it's real. You can also look at my newsletter. It comes out every week. We finished up 44% last year. My trading group has 2 webinars per month. Now, the trading group is a little different. You get trade alerts throughout the month, but in each webinar, we actually have kind of a little tutorial, and I try and illustrate different principles about trading from the trades we're doing in the trading group. I'm trying to teach people. I'm trying to teach you how to fish, not just handing you a fish. And then the conservative income trading service is actually modeled after the course that's starting next week, where we're just selling calls, selling puts. And again, that's mirroring another one of my personal accounts. Now, it finished up 26% for 2020. Now, when you compare the trading group and the conservative income trading service, it's a fascinating comparison. The average trade in the trading group last year was at 27% profit. But the range of results went from 100% loss to a 1,667% gain. So there's a huge, I think the standard deviation was about 3, plus or minus 3. So it's like 27% plus or minus 3. Conservative income, by contrast, we've had that service open for 57 months. The average monthly gain is 1.07%, 1% a month. Now, you do that steadily year after year, it's not bad. Just as importantly, the standard deviation is 0.03. In other words, it was a very tight range. You may make 3% this month, may make 2% next, may lose 1%. It's a tight range. And you can see that in how both of these services did in March of last year when we had the big correction. The market was down. S&P 500 was down 35% at the end of March. The trading group was down 35% at the end of March. The conservative income group was only down 10%. Big difference, especially if you're sensitive to that sort of thing and have a tendency to hide under the bed. That might be a more comfortable service. But the other thing that's just as important about this comparison is that both groups recovered from the correction within 30 days. And obviously, the trading group did well the rest of the year. And so did conservative income. The S&P 500 ended the year up 15%. So both groups survived the correction, bounced back. It took the S&P 500 5 months to get back to even. So if there's questions, I'd be glad to answer them. Got a few minutes left, I think.
We do, and on behalf of all the participants, Dr. Duke, thank you very much. I am first and foremost going to do one thing, and that is go to the chat box, and we do have a sort of semi-comment, semi-question in here. Debit spreads can get small gains fairly often. Credit spreads, you can take losses way before they get to a max loss. You don't have to be a max loss or a max gain. And so, like I said, it's kind of a statement, but would you like to react to that as far as you're concerned, Dr. Duke?
As far as I'm concerned, I don't believe it's true. Either trade, any spread trade, makes its profit based on time decay. And why the time decay in a credit spread would be different than the time decay in a debit spread, I don't think that's true. And so I would challenge that premise.
Gotcha. Okay, we do have another question, and then we actually have a couple of political questions as well, which might be kind of fun for you. Um, Actually, I'll put the political ones on hold for 1 second, but you mentioned some of your sample portfolios and the side-by-side mirror trading and so forth. The general question is, how far up or down is your sample portfolio for the fourth quarter, and if you even have it for the entire year of 2020?
Okay. The newsletter in 2020 was up 44%. Now, the newsletter only has I write the newsletter every week and kind of survey the entire market and kind of give you my opinion about where it's going and so forth. And then in between newsletters, I send out a trade. Now, usually I only send out about 1 or 2 trades per month. So that's done on a limited number. But they ended up 44% for the year. The trading group ended up 370%. Now, 370 is it's kind of deceptive. The problem about percentages is to figure out, okay, what are we going to base this on? So what I did there is I just simply assumed that you put one contract into each trade. And so it starts with a small amount of money, just $2,000 or $3,000, and you're just assuming you put one contract in each trade. So that's how you get to the 370. And then conservative income assumes that you have $100,000 because you need a fair amount of cash to trade income by selling calls and selling puts. You can't do it with 10,000 bucks. And so that assumes a $100,000 start, and that was up 26% for the year. Does that answer the question? Or?
I assume so. Sounds like a good answer to me. We have several more questions here. Do you ever use calendar spreads?
Yes. In fact, we have a double calendar in the trading group right now on Applied Materials, AMAT. And what we're doing there is we've got a calendar up above the current price and a calendar below. And we're selling the options that will expire this Friday. And we're buying the February 12th options. So we'll plan to roll our Friday options out on Friday. And the point of the calendar spread is this. Applied Materials has a earnings announcement, I think on the 10th, if I remember right. And what we're betting this trade on is that as the calendar spread, as the legs increase in implied volatility, the value of the calendar spread increases, and also the break-even range or the profitability range of the calendar spread widens. And so it's a very powerful trade, but it's actually more sensitive to implied volatility than it is to the price of the underlying stock. I mean, the underlying stock can swing higher and lower, but your real exposure to a loss is if implied volatility declines. And so we're using, in this case, banking on implied volatility going up as we approach the earnings announcement. So we'll close this one before the earnings announcement because we don't want to take the risk of being in the earnings announcement. So yes, we use calendar spreads mostly as volatility plays, just like that one.
Great, thank you. That was from Bill. We have a question from Lewis. Do you use diagonal spreads to overcome the negative expectancy from credit spreads that were in your examples?
I do use diagonal spreads. I usually am, especially in this market, I'm usually using diagonal call spreads, bullish positions. And part of the thing I like about diagonal spreads is that, in effect, you're buying a call farther out, and then you're selling a call in the near week, usually. And so it's kind of like a covered call in a sense, or a bull call spread. But the beauty of it is week by week, as you roll out, you're reducing the cost basis of that long call. And in effect, as your cost basis reduces, if the whole stock went to zero at some point, you've reduced your maximum loss. So as you're going, your risk is actually going down. And of course, as you do that week after week, you're generating a better and better profit. And so it's a very good trade. Part of the reason I like it is it works if the underlying stock is trading sideways, It could even trade down a little bit, and it can trade up. Now, if it trades up too quickly, you can have to maybe force to close it early. But it's a very powerful trade because it doesn't have to be, you don't have to have grabbed a hold of the stock that's just going straight up. It'll do very well for a stock that just wanders sideways and slightly higher. So we use that a lot.
Great. Great. Okay, I'm not going to let you out of these political questions. Actually, we have several in here. I'm going to kind of combine two into one, and then I'll let you off the hook after that. Okay, so basically the two questions I'm combining are any major investing themes that you see coming out of the election? And with the election over, are you planning to adjust your positioning?
No, I could, if I was of a different political persuasion, I guess I might be threatening, like people sometimes do, that I'm going to move to Canada or something. But, no, I'm going to stick around. And actually, ever since the March correction, I've been puzzled by this market, because it's one thing to bounce back. I mean, I could see why it fell out of bed in March, but how on earth can we justify the levels of the market that we're seeing for the past several months? I can't. But, you know, I earned a PhD in chemistry way back when, and consequently, I'm kind of a nerdy guy that wants to know what the answer is. And I always, when I was trading just stocks, I was the one that was going through the balance sheets and trying to figure out what the PE ratio was and so forth, so on. And I learned pretty quickly that even though I might think I knew what was going on, it didn't work out the way I thought it should. And that's taught me a valuable lesson that extends into my trading today, whether it's with stocks or the options, is that the rational case very often just doesn't happen. And so what I do largely with my trading now is I trade I guess two things. The positions I have that are longer term, where I buy a stock like Apple and hold it for years, I kind of hedge that bet by selling calls against it almost all the time. A lot of my trading, though, is just very short term. You know, I'm just selling puts and calls, or I'm trading diagonal spreads or calendars or whatever it is, but they're only a few weeks long and I'm out. And I move from stock to stock based on what the chart's doing for the past few months or past few weeks. And so lots of times I'm playing positions on stocks that I don't have a clue why they can be trading as high as they are, or why they're going straight up like a rocket. And I just try not to worry about it. That sounds silly, I'm sure, but that's where I am. I just try and take advantage of the market that I see today. I try my best to control my risk very diligently. And so even if I think this stock is the most wonderful thing, if it starts to falter on me, I'm out of there. And the bottom line on all the services for last year, it was kind of interesting because in spite of the fact that many of them take much different risk levels, we had win-loss ratios in all of them of about 75%, plus or minus 1%. And wow. That's part of the secret. If you can manage your losses so that you don't have that many, and number two, so that they're not huge, well, you can end up making money. But if you're asking what's the rationale for the current market, I don't have a clue. In fact, I'm puzzled to death. Getting to the politics, I will go out on a limb and say, as far as I'm concerned, the politics of the current administration are not going to be positive for the economy. It's going to be back to the way it was 10 years ago, where we're just kind of wandering sideways at best, because we're just going to have higher taxes and more regulation, and that doesn't do well for the economy. And so, but again, I was making money back under those previous administrations as well, so I can live either way, but doesn't mean I think it's the best way to run the world if Duke were in charge, but he's not.
Right. Well, I'd vote for you. We actually have two more questions here. One very important one from James. This is regarding your courses. And James asks, if I can't make it one particular week, are they taped so that I can refer back to them for the week that I missed?
Yes, yes, they're all recorded, and I have them on my website so that you can stream them to your iPhone, your pad, or computer, whatever. And that's unlimited. You can stream those previous classes as often as you wish, for as long as you want. And now the software actually limits it to 3 months. And I routinely, if you send me an email and say you want to go find an old class that you took, I just re-up it, start the clock again for another 3 months. So yeah, you can continue to go back and stream those and check on things that you wondered if what did he say back then, and also you get all the PDF files, the slides you get in a PDF form, so you have all that to refer back to.
Great. Great. So I had. Sounds great. Got another important question here. Can you hear me okay? I'm breaking up a little.
It was
Can you hear me
breaking up a
okay?
little, but I've got you now. At least I did. Are you still there? Are we live? Steve, are you still there?
I am. Can you hear me?
Yes, I can.
Okay, there I go. Sorry about that. Okay, one other question. This is from Bill. Can you your strikes when you sell calls against Apple?
I missed part of that. Can you do what with strikes?
Can you share, in other words, will you share with the group here how you pick your strikes
Okay. Okay, sure.
when you sell the calls against Apple?
Okay, now it depends. If it's my long-term holdings where I don't want to lose the stock, then I typically go 2 months out and go a bit out of the money, maybe $5 out of the money. So then after about 30 days, I'll buy that option back and take whatever profits there so that I never get in a position where it's likely to be called away. Now, in my other account where I'm trading I'm just optimizing as much income as I can do in a month. There I trade Apple a lot, and I always trade typically just the at-the-money option, the at-the-money call or the at-the-money put. And the reason for that is the at-the-money option is always the most expensive, and I'm just interested in bringing in the most cash. I don't care if it's called away, if it's a call and I sell the stock, or if it's exercised and I buy the stock, and then I'll just sell a call the next week. And so it depends on that's one of the things we spend a lot of time with in the course are the different cases and the different types of traders in terms of your own risk profile, because which strike you choose has to do with your situation and also your own risk tolerance. Did I lose you guys?
Okay, no, yeah, no,
Okay.
I'm here. Sorry about that. However, I believe you have successfully answered all the questions, including our fun political question. So, unless I see anything in the next couple seconds in the chat room, I believe we are complete. Any last thoughts, Dr. Duke, that you'd like to share with anyone about anything?
No, I guess I try. My answer to the political question is probably typical of my coaching and my services. I try as best I can to always be straight with you and point out to things that are good and the things that are bad. And more importantly, always point out that there's no free lunch. So there's always going to be a disadvantage to whatever it is we're doing. And it's important to know that.
Amen. Okay, on that note, I will let you know that even though you have never owned chickens, I have. A lot of fun. Any traders out there with younger kids, they make great pets and they're a lot of fun. Anyway, more importantly, thank you to all of our participants, and special thanks, Dr. Duke, to you. That is Dr. Kerr Given, PhD, and thank you very much for the myths of option trading, and great presentation, great job. So everyone, please come back to our website early and often and see what we have coming up in future webinars. And Dr. Duke will be back with us for another webinar soon, and we have our next couple up there. And I think that is it. So thank you all. Have a great rest of the week and weekend, and we look forward to seeing you on Option Hotline again soon. Thank you very much, everyone.
Thank you, Steve.
You bet.